Here we're going to go through recording contingent consideration using the acquisition method here for business combinations. This is where the company acquiring another company agrees to pay an additional amount of cash in the future based on some target performance by the company being acquired. First, I'll go through an example here for the basic review of this acquisition method and how to calculate goodwill. Then I'll apply it to recording contingent consideration by going through another example. Here we'll go through an overview of the acquisition method here for business combinations. And for the example, Corp A will acquire or buy all of Corp B's net assets, that is, its assets and liabilities. And to demonstrate the basic accounting for this business acquisition here, I have set up Corp B's balance sheet showing its assets, its liabilities, and its shareholders' equity. Now, accounting for the acquisition method, that's based on the fair value of the assets and liabilities being acquired. Now, we must identify all the assets and liabilities involved and determine their fair value at the acquisition date. Now, looking at Corp B's balance sheet here, I have set up both the book value and the fair value of the assets and liabilities. Okay, to account for this acquisition, we're going to do a value analysis. Now, we're going to purchase these net assets at their fair value here, and we're going to exchange common stock for the net assets. So Corporation A here is going to issue common stock to Corporation B in exchange for the net assets of Corporation B. And our first scenario here will be the price paid here is greater than the fair value of the net assets received. So to determine our fair value of the net assets here, we've already determined that here by looking here at the $860,000 worth of our total assets here at the fair value, and then subtracting here the difference or our fair value here of our total liabilities of $140,000. So we have $720,000 of fair value for our net assets here. And because the price paid is greater than the fair value of the net assets received, there's goodwill involved. So to determine our goodwill here, we determine the price that we paid, that was the stock that we're issuing here for $800,000, and then subtracting the fair value of net assets that we're receiving from it for $720,000, we get goodwill here of $80,000. So here's our goodwill here, and that's its fair value here on our balance sheet. Okay, looking at our contingent consideration example, this is where in this case, we agreed to pay the company we're acquiring, Corporation B here, an extra $20,000 if they meet a certain performance goal here by a certain date here. So what we do here is we increase the fair value here of our liabilities as a contingent liability here by $20,000. Now what this does here is it increases our total liabilities from $140,000 for what they were previously to now $160,000. So when we calculate our fair value of our net assets, we still go back here and we use the fair value of our total assets here that remains at $860,000, and now our new fair value here for our liabilities is $160,000. So subtracting the two here, the $160 from the $860,000 of our assets, we get a fair value of net assets of $700,000. Now if we carry it down into our formula here to calculate our goodwill, we still have paid $800,000 for or issued $800,000 in stocks to Corporation B for those assets and liabilities that we're acquiring, but our fair value in our net assets has decreased here from $720,000 to now $700,000. So taking the difference between the price paid here of $800,000 less the fair value of our net assets here of $700,000, our goodwill is now $100,000. So we've paid more here. The price we paid here is greater than the fair value of the net assets we're receiving. So our goodwill has increased from $80,000 to $100,000 based on the increase here in this contingent liability of $20,000. Okay, looking at our journal entries here for this contingent consideration, and we're looking at it here from the point of view of the Corporation A or the acquirer here. So on our liability side here on the balance sheet, we had a $20,000 increase here due to this contingent consideration that we're offering to the company that we're acquiring here. So it increased from $140,000 plus the $20,000. So now we have $160,000 here in liabilities. And on the asset side of the equation here, this goodwill, that also increased by $20,000. So we had an $80,000 initial amount here, and plus the $20,000. Now we're up to $100,000 here in goodwill. And that would be the only change here for our journal entries. Everything else remains the same regarding our common stock that was issued here, and any of our recording of our assets here at fair value, and any of our cash transactions for the expenses here, that for the acquisition expenses. Okay, the procedure that we've gone through here applies to any contingent payment payable in the form other than the issuing of additional shares of stock. An agreement to issue additional stock upon some occurrence or event here is considered to be a change here in the estimate of the value of the shares issued. No liability is recorded at the acquisition date for this. The only entry made is at the date of the added stock issue. The procedure on that date is to reassign the original consideration assigned to the stock to a greater number of shares. Okay, in summary, when we're dealing with contingent considerations in business acquisitions, from the acquirer's point of view, the contingent consideration increases the liability here. Thus, it reduces the fair value of net assets we're receiving here, and that would increase the goodwill here. So say the price paid here remains the same, fair value of our net assets here reduces, thus the change in our goodwill increases.